Hi, everyone. As you know, today is another lesson. So, today we have the lender. He'll be speaking on the mortgage requirements. So, listen up, listen to the
Good day,
full
everyone. How are
video. And
you?
I mean,
My
say,
name's Ronnie
listen to
Justice
the
Jr. I'm a mortgage banker for OVM Financial. We're part of the Annie Mac family. I wanted to do this quick video for my realtor partner, Jessica Edwards. She's doing a TikTok video. So I want to be able to provide some value to you guys from the lender's perspective when it comes to home ownership. She gave me a list of few things she wanted me to go over, so I'm gonna make sure I stick to the script. I may go left a little bit, but I want to be sure that everything that she was looking for from me is encompassed in this video. All right. Hope everyone is having a great day, great, wonderful day, and looking forward to becoming a home buyer. All right. So the first off, the importance of credit. Like, you can't do much without credit out here. Just think of 10 friends, right? And you can number them from 1 to 10 or what have you. And the one that's listed at 10 or labeled as 10, that's the one you know you can give $20 and they'll give it right back the same day that they said they would, on time, might even throw an extra few dollars in there for you, right? You get down to the number 5, less per se or whatnot. That person, you give it to them. They may come around in the next 3 to 4 weeks after they told you they would pay you the following week. 3 or 4 weeks later, they may give you half of that $20, and then another 2 weeks go by, and then they give you maybe the 10, right? You get around down to that 1 or 2, you almost paid them just to leave you alone, man. Interest rate through the roof. That $20 would have cost them probably 70 by the time that they finish making payments on it. So I'm saying that to say that credit score and FICO is important. Even with the way I just put it as your 10 friends, you label them 1 through 10, you have a FICO that goes from anywhere from 400s up to the 850s, right? You want to be tried to be in that bracket as high as possible. Yes, the higher the better, but it's not completely necessary to be able to buy. 600, you're pretty much good. People do loans at 580. I can even do a loan at 580, but I don't promote those. It's a hard loan to pull off. It's not a good one, and it's going to cost you. Most people that have a 580, you won't even have the funds to do the other side. Not saying that you don't, but usually people with a 580 credit score hasn't done enough with their credit, paying on-time bills, everything like that. So it's tougher for those to get approval. But one of the biggest things about credit, redundant, you're going to hit, pay your bills. That's it. Pay your bills on time. Make sure you send the payment in. Send it early if you need to. Put a little extra on principal. That even helps buy down some of the interest that you'll be paying over the term of whatever loan that you so chose or what have you, right? Be sure you never to co-sign for anyone. You can do authorized users on other people's accounts to help build your credit. Just be sure that this person pays their bill. They either 8, 9, or a 10 in that list of friends that you have. Just be sure that you know before you allow them to sign you up on their card. I've seen some of the most, and you mess around and sign up somebody is 80%, almost 100% utilized on that card, missed 6 payments in the last year, what have you. So I'm saying that to say be sure who you're becoming an authorized user on their card. It does work. It helps. But again, be sure that it's a reputable person that does what they're supposed to do right by their own credit before you try to get a boost off of theirs. Also, I wanted to go over a few loan types as well. Obviously, you know, you have the USDA loan, which is more so for the rural areas. You can go to the USDA website, type in an address or zip code, or just pull up the map of whatever area, state, what have you that you live in. You're able to go up there to see exactly where a USDA loan is able to be used at. That's one of the stronger loans, and I'm saying that to say because it comes with no down payment. That's a boost in itself, right? The purchase price will be a little lower than your other loans because of the DTI caps, or a little shorter than the other ones. But again, it's still a good loan. If it works and it fits your situation, then I'm going to say run with it. Definitely get you a lender, right? And I'm going to say this. I even tell the people that work with me, shop 3. I'm going to beat the other 2. I'm going to do that. But I'm saying that to say, be sure that they have all the products. So that way, anything that comes up in your situation, they have something that they can apply to it, right? You don't want to go somewhere that's telling you, hey, we only have conventional FHA or what have you. And you went somewhere in a zip code that was USDA approved, eligible, and your DTI would have fit that home in that area, but you stuck with that banker and you didn't get a good deal, right? My goal always is to be sure, no matter what loan, no matter what period of the economy we in, the status of America, no matter the president, no matter what, I always try to put you in the best loan available on the market at that time that you were buying. All right. So that way, if you never get an opportunity to refi, I still know that I did right by you years later down the line, right? At that moment in time in that market, be sure you get a lender that cares just as much. All right. Also, I want to talk about FHA loans. It is for low to moderate income, moderate credit, or what have you. But people that have better credit and a few extra dollars in their pocket also use it. It depends on the situation. Mortgages are one of the most situational things that you will ever deal with. You can find two people, make the same exact money, work the same job, have the same type of bills, everything like that. But the mortgage still won't line up the same. So I'm saying that to say, big tip. Do not listen to your friends. You can get tips from them, but their journey isn't yours. You know what I mean? So I'm saying that to say, once you get on your path, walk it accordingly because it's yours. You know what I mean? You can't walk your path with somebody else's in your mindset and everything. Yeah, you can take tips and everything like that from them, but again, your path is yours. So I'm saying that to say, once you get on it, get with somebody that can help you and guide you down your path, not somebody else's or whatnot, because just because they was able to do it and they told you they got this interest rate, this down payment, it was their situation. They might have had a great realtor that negotiated enough seller concessions for them to get them a no down payment or no closing costs. So I'm saying that to say, make sure you get your situation laid out for what it is for you. All right. Also, FHA is 3.5% down inherently. You can use multiple times, and it's only 3.5% down, which is great. But you can only have one FHA loan, so you need to have sold your existing FHA house before you move into the next one. Now there are a few little what I want to say caveats or alterations or loopholes I want to say with that, where you can buy multiple ones if you move into a state over 100 miles away or what have you. You can. We just got to show that your job is out in that area or what have you. Also, you have the VA loan, which is one of the better ones because it comes with no down payment inherently. It doesn't even come with mortgage insurance. With the FHA loan, has mortgage insurance and it's for life of the loan. Mortgage insurance is when we pay a fee. Any homeowner pays a fee for that mortgage to be covered just in case you default on that loan. Then that way the lender, whoever gave you that money, can get some type of compensation back on the money that they would lose when you defaulted on your loan. All right. FHA comes with it for life. VA doesn't have it. The government guarantees it for all of our soldiers, active duty members, and veterans, ones that serve. Thanks to you guys for your service. That VA loan does look out for you. They give you all the money that you need. The house is $300,000, then we give you $300,000. You don't have to put anything down on it. All right. Also conventional, which is the normal go-to. I usually don't start looking at conventional until you get around 680. You can do a conventional at 620, but mortgage insurance is going to hurt you on that one. That's why most time when you are that low in that credit bracket, you would go FHA because that has what I want to say inherent mortgage insurance rate versus mortgage insurance on a conventional. It varies based on your situation as far as credit, your DTI, everything, the LTV of the loan. It's a lot that goes into that, but like I said, if you're in a lower FICO range, then it'll be fairly expensive, and sometimes it's easier just to go the FHA route to protect your interests as well. We have a lot of other loans as well, right? So say for instance, if you're a business owner, right? A lot of business owners always feel like home ownership isn't for them, right? The thing is, your taxes weren't filed in a way to show your true income on that business. You probably did a lot of deductions, and it's understandable. You do the deductions to avoid having to pay a lot of taxes, but then when you're not able to show that you took home a lot of money, because just because you tell me you made, hey, 120K in a business, does not necessarily mean you took 120K home. So I'm saying that to say, when you do all the deductions and everything after that, that's the number that I'm able to use. And we do an average over 2 years, and we do a couple of other things to try to pull as much from taxes as we can with business owners. But most time they write too much off and they're not qualifying for the amount that they want to see, if at all, right? So we have bank statement loans where you can give me a year, 2 years worth of bank statements. I can calculate your monthly income based on the deposits and everything that you do with those. We have 1099 loans, and we also have asset loans for the ones that have more money than income, right? Then we can get an average of that to be able to get you in a home as well. Just those loans come with a little higher down payment, anywhere from 10 to 20%, right? Versus the traditional loans, I mean, the max you'll be around 5% on the conventional if it's your second or any home after the first one, all right? So I'm saying that to say, you do have opportunities to become a homeowner when you are a business owner, because there are different products out there for you. One of the best things is to prepare when you know you want to become a homeowner. You may have to prepare 2 years in advance, but I'm saying that to say that'll save you a bunch of money if that's your timeline. But if you know you want to be in something now, and the market is looking pretty good now as well, I would say that the bank statement will be one of the stronger options, as well as the asset loan and the 1099 one as well. All right, for all the self-employed contractors or what have you, we do have products that will put you in a home, get you where you need to be, so you are that successful homeowner and not just limited based on your tax years that you file or whatnot. And most of those loans, we don't even need taxes as well, which is a good thing. All right. DTI, debt to income ratio, right? So FICO is important, right? That number basically lets me know that I can lend you money, right? As long as you fit within that bracket and the credit isn't that bad, then the FICO tells me that I can lend you money, because that score pretty much graded you on you paying that money back, right? DTI determines how much you get. That's, to me, just as important, if not more, depending on how you want to look at it. Because the credit we can get people to come in, help you with, but I can't make you more money or get rid of your debt unless you're paying it off, right? So I'm saying that to say it's based on the amount of debt that you have coming out of the income that you make monthly. All right. We do the equation. We come up with that number. Different loans have different caps on their DTI range. Like, let's just say FHA is around 55%. Conventional is at 50%. VA is around 65%, which, granted, here at OVM, we don't have any overlays, so I can run it up a little higher. Just as long as your credit is good and it accepts it, you're going to run with it. But when I'm saying these DTI cap numbers, this is saying like, hey, you have your mortgage, which is around $1,000 or whatever the price is, and that goes in conjunction with all the other liabilities that you have, right? So say, for instance, you have your mortgage, you have a couple of credit card bills, a car note, and a few student loans, right? Those numbers can equate more than 50% of your monthly income, right? That's what the DTI does. So if you have a gap in there, that means we can fill it with more income, which means a higher purchase price, not more income, I'm sorry, more debt, which means a higher purchase price equates to a bigger house, right? So the more gap that you have in your DTI, it can be filled with more debt, which means a bigger house. So anywhere you can go from, let's just say your DTI range is around 40%, then you may have enough cap to add another 10 to 15 to 20,000 in that range. And it just took you from, let's just say 350K to 400K, right? So you do have a range, and there are ways where you're able to do it right at home Easiest way to link yourself with a good banker who doesn't mind running your numbers, to let you know what the DTI looks like, give you your purchase price. And I love to give all my clients a range. You know what I mean? I always ask them what's their comfortable number, right? Because I don't want you to rob yourself and turn yourself into a miserable homeowner. If you know you like to buy a bag every other month or take a trip every quarter, or your kids in football, you know, they like to go out every other weekend. I don't want you to rob yourself of your lifestyle to be a homeowner. Yes, sacrifices have to be made. You pick and choose those, but I don't want you to completely halt your whole lifestyle to be a homeowner, because you'll be miserable. So when I ask that comfortable number, I like to know that number that you know you don't want to go over, that still puts you in a position to do all those lifestyle things that still made you who you are, right? You don't want to become a homeowner and have to diminish everything that you are, the things you like to do and all that, and got your kids miserable because all they can do is go outside, run around the yard, and all you can do is afford to go to work and come back home, right? So I always ask the comfortable number, and I will give you your purchase price based on that comfortable number. So if you tell me, hey, $2,000, I can't go over that, I don't want to see myself over that, right? I will give you your purchase price based on that number in your situation, right? So you say, hey, Ron, I want to be at $2,000 a month, so I'm going to draw up the loan to meet that 2K. But if it's anything over, I will let you know. So hey, say for instance, the 2,000 put you around $225,000, right? That now you know you can buy a house at $225,000. My payment's only gonna be around 2K because Ron ran the numbers and I did, right? And then I also tell you like, hey, you are able to get up to $300,000. Now you know your range. I will let you know the payment at $300K. You already know what the payment is at your comfortable place at $225. Now you can play in between. You always can discuss it with me when you find a house price, anything in between, so that way we can always run the numbers and keep you in the knowing as far as, hey, if I buy this house, this is what this payment look like. You know what I mean? Be sure your banker is doing the same thing. You don't want to show up to the closing table, find out that the payment is outside your range, right? Then you already invested a whole bunch of money that you will not get back into that deal, all right? And honestly, somebody may hold you liable if you get all the way to that far and decide you don't want it, to be honest with you. So be sure you get with somebody who's truly on your side, that's going to give you everything that you need to know, okay? We also have pre-qualification versus pre-approval, okay? Now, I can get on this phone right now, give one of y'all a real good interview. You'll tell me pretty much how much you make. I may ask you what your FICO looks like. You'll tell me. I'll ask you what your liabilities look like. And then we can run some little like numbers or whatnot. That'll be your pre-qualification, long as everything lined up based on the conversation we have, the numbers, the guidelines, the DTI ranges. It'll just line up. I can give you a pre-qual. It's not much substance behind it, but it is one. You know what I mean? You're able to use it. Most realtors won't take you shopping nowadays with it, but if you request it, I'll provide it, right? But the pre-approval is the one. The main difference is the level of verification between pre-qualification and pre-approval. The pre-approval, the full one, you go through the underwriters. They're the end all, to be honest with you, but they go through your whole file to make sure the same monies that we're asking for lines up with your whole entire situation. All right. We also do VOEs, which is a verification of employment. We reach out to your employer just to find out that, hey, they actually do work here. They actually do make this much, and they will be getting all this overtime in the next year, as long as they want to get it, right? That's where we get the true verification of your pay. We see the pay stubs and the W-2s and all that, but a lot of people doing a lot of things out here. So that last level of verification is paramount, to be sure that everything that we are seeing on your stubs and W-2 is verified, coming directly from the company, okay? You do VOR, say you're a renter, we'll get with the leasing office, landlord, what have you. Be sure you hadn't missed rent in the last year, if need be. But it's also other levels of verification. You do a VA loan with pulling your COE. Hopefully you provided your DD-214 when you submitted the loan. But if not, we are able to do that. We also do CAVers to be sure you don't owe any government monies or anything like that. But once that comes back and you get through all of that, that's when you know, like, hey, this money is for me at this point. You know what I mean? Now, it's up to you how much you ever want to spend it. Because like I said, that last example I gave, I might be able to approve it for the whole 300K, but you only told me you wanted 225 of that, right? So I'm saying that to say it's up to you how much of it that you want to use. I'm one of those bankers that's going to say, hey, you said you wanted this number. I don't want you to hurt yourself, but I'm not going to stop because you'll just walk right across the street and they'll give it to you, right? But me, I'm going to always remind you of the limit that you set on yourself, right? Because if we're going to hold each other accountable, I wouldn't be me doing me and be the person that I say that I set out to be and that I am if I didn't let that be known, all right? Because I never want to set no one up to be hurt with a mortgage after they leave my office or once they close. I want to know 3, 4, 5, 6 years down the line, you still comfortable in that home. You know what I mean? Matter of fact, I want you to be to the point where you calling me in 5 years and I'm explaining to you what equity is and how you can tap into it to become that true business owner that you wanted to be because you're tired of your job and tired of everybody that's working there with you, right? And I know you're good at something. Nobody next to you is better than you. You're able to do it. Now I can show you how to get the funds to become that. All right. There's a lot that you can get out of home ownership versus just somewhere laying your head, making love to your mate, fellowshipping with family, arguing with your kids, fussing at them. Right. It's something that you can turn into, I ain't gonna say complete financial freedom because there are methods you can do it. Right. You got to be adamant, but they may not be your goal. You just might want to be able to get in a home, pay some debt off. You can consolidate all your debt within your home. You can make new purchases. You can become a business owner. It's a lot that you can do with becoming a homeowner that you would have never done with renting, right? Rent is 100% interest. Man, all that money that you add up and you spend all year long goes to the knot, right? It doesn't go to any equity. It doesn't go to any type of investment. You're paying your landlord's mortgage, right? So whether you're renting or buying, you are paying a mortgage. So I'm saying that to say now's the time to go ahead and make yourself a homeowner so that way you know when you're paying that mortgage is yours. Nobody is making a few extra $100 off for you every month. It's something great for what I want to say, the legacy that you say you want to create. A lot of people always say they want something to leave behind. I mean, even if you buy the house and the house isn't left behind, they could take all that equity and change their whole family tree forever where you never saw fit. That legacy is still in place. Understand that. So it's not necessarily in the home. It's the act that you did when you provided that home. Now what that home is able to provide to your family's future, that's where the legacy is. It isn't necessarily in those four walls or however many that it is in that home or whatnot. You got to understand that. To me, that's what I want to say, a simple mindset. Not a simple person, but a simple mindset to think that you have to keep that house in order to survive the legacy or keep the legacy when the kids probably don't even want to move back in the city that the house is in, let alone even be in that type of house that mama picked out for herself. You know what I mean? So I'm saying that to say, but that equity is there. The kids are able to tap into it. They might become the next Warren Buffett, the next huge investor. They might got a huge invention somewhere around the corner that just needed a few dollars to fund it. The legacy is still intact, all right? There are a lot of grants in our areas. Virginia Housing is one of the ones that gives them out. They also do down payment assistance. You can get grants on your conventional and FHA loans. We can get closing cost assistance grants on VA and USDA loans. We also have a few ones in the city. Norfolk does pretty well with loans and grants for their program, first time home buyers. They even have a grant to help you with the curbside appeal. Like, understand that. Like, you can get a grant to help you out for everything from your front door to the curb to be sure that your house is appealing, okay? There are also grants in Chesapeake. There's a lot of grants that help out first-time home buyers. There are certain cities in our areas that do nothing for first-time home buyers. Understand that. So get with your lender and your realtor to make sure you understand which city it is that you're moving to if you are looking forward to grant. Because grants are great because you don't have to pay them back, not by far or whatnot. Some of the mortgage requirements when you are applying for a mortgage, all right? I call it the 2, 2, and 2, the triple threat, right? I need two bank statements, your last 2 pay stubs, and your last 2 years W-2s. All right. We are in 25. I know everybody just got their 24 W-2, but it's not completely necessary until April 15th of this year, right? So most time I'm still asking right now for 22 and 23. After April 15th, I will only need 23 and 24. All right. Once you supply all those documentations or whatnot, then your lender, myself, or any other good one, make sure you find a good one, will be able to run the numbers and get you, all the information that you need to be able to move forward. Whether it's right now, 3, 4, 6 months from now. You know what I mean? Delay is not denial. So if I'm telling you it ain't your time, that doesn't mean stop. When you quit, you lost. Understand that. Work on your credit. Bug me. Get on my nerves. Because the more you get on my nerves, the more I'm going to do for you. I promise you. Because I'm going to make sure you win and get out my way. I promise you. You know what I mean? So I'm saying that to say the squeaky wheel get the grease. You know what I mean? Nobody want to hear no squeaky wheel. They're going to get tired of hearing. They're going to get down there and do something about it. You know what I mean? So I'm saying that to say you are able to bother me when it comes to that. I don't know how your other mortgage bankers move, but bother me. You know what I mean? I appreciate it because it keeps me on my toes and I'm out here to serve like I'm truly supposed to. So I'm going to do just that. And if you ain't calling me, I'm going to reach out, but you got to show me you in it with me. All right. I can't make you win alone. Outside of that, I wanted to be sure that I covered everything that Jessica wanted me to cover or whatnot. I know I went over my time, but I can't help it. I get to talk and I get to running it, and I want to make sure you guys get some type of value out of this video. All right. Again, if there's anything else that you guys need, my name is Ronnie Justice Jr. You can find me on social media. You also can find me, look me up, OVM Financial. You can Google me as well. If anything is needed, like I said, reach out. I'm here for you. Have a blessed day. Bye.